Okay, now I think we have audio. We didn't before.
All right.
Can everybody hear me now? I am so sorry. I'm going to do this all over again here. I guess there was an audio issue. Thanks everybody for being here. Yes, now you know this is live, right? I am here down on the floor of the SIBO in the S&P 500 options pit. And boy, what a difference an hour, 2 hours makes. It was just a couple hours ago. We almost seemed like it was potentially going to be a repeat of yesterday's wipeout. S&Ps were down 30 points. Things were looking a little bit dire. And then all of a sudden here, let me show you on a chart. Okay, check this out right here. This is the S&Ps. Okay, this is today's trade. This big candle right here with this wick. This red line that you see right here, 50-day moving average. Okay, the 50-day moving average in the S&P 500s is 54.24. Our low on the day today, it did trade down all the way to 53.90 underneath that, and that's where the buyers came in massively. I was talking about earlier, you guys couldn't hear me. Big volume in the S&Ps today, S&P futures. 1.8 million contracts so far. Typically, average day, we get about 1.5 million contracts. 1.8 million already. S&P's now up 53. So whether it was what we see here on the screen or something else, which I'm going to tell you about also, a change in the landscape of potential interest rate cuts from the Fed, and we'll go to that shortly. But what I want to do right now is just give a real quick overview in the markets here. Hey, Bill, can you hear me now? Everything good? Everything good now with sound? I know we had a little bit of an issue when I first started. So if you can let me know.
Yeah, it's
Okay, good. Okay, so what did we do earlier today? Earlier today, oh man, Uber, we actually got to send out an exit signal here. Earlier today, this almost coincided directly with how the S&Ps were. Look at that right there. Do you see this blue line here, everybody? That's the 200-day moving average. We were waiting for that to hit. We sold a put spread this morning almost on the lows. Almost on the lows. We sold this thing here for $1.50. In fact, Mike, can you ping Jeff Lake over here somewhere and let me know when you ping him? We sold that at $1.50 this morning, guys. Okay, it's trading about, I don't know, 60, 65 cents right now, somewhere like that. You got to remember something that I learned literally here in the pits that you should all follow. Bulls and bears prosper, pigs go to the slaughter. Bulls and bears prosper, pigs go to the slaughter. What does that mean? That means you can be bullish, you can be bearish, you can be neutral. But if you're a pig, you're going to get run over. Take your profits, set stops, trade like a pro. That's why you're here. That's what these guys do. That's why they're successful. Okay? Uber. We sold this thing at $1.50. If we can buy this back somewhere 60, 70 cents or so, boom, we are going to do that. Let me show you another one. Let me show you another one right here. Gold got hammered this morning. The ETF for gold, okay, so something that is very liquid, very tradable. GLD is the spider ETF for gold. Look at that right there. That thing came right down to the 50-day moving average. Now, is it going to break through to the downside? It might. It absolutely might. But if we look at, especially over the last 6 months or so, okay, here we go. Here we go. Broke down a little bit, and then boom, right through again. And there's the 50-day moving average. Remember, whatever technical indicator you guys are going to use, and there's gazillions out there, whatever technical indicator you're going to use, past performance is indicative of future performance, right? So the technical indicators we're all looking at, regardless of what they are taking what has happened in the past to try and predict what's happening in the future. 50 and the 200-day moving averages are two of the most simple ones out there to really, take a look at understand. I'm not saying make every trade based off of those. Certainly use other things, but wow, those are good ones. So we got into that as well. What else is going on today? Well, you know what? Everything is moving. Tech is still a little light today. We did see Meta recover. It is pretty much unchanged now. It was down pretty big earlier. AMD is down. Micron's still down a little bit. Actually, it's pretty much unchanged right now. The rest of the market, though, especially the small caps, especially the Russell, unbelievable. Okay, Jeff Lake, if you can send out an exit signal in Uber to buy back our put spread for 60 cents or less, I would appreciate it. That will be for the entire position. Make sure you include something in the signal that identifies be careful for PDT pattern day trading, since this is a day trade potentially. Okay? Hopefully Jeff gets that out for us. Those of you that are Prosper members, you know Jeff Lake. He was a great trader of mine back in the day on the floor and one of the great educators here. All right, so what else is going on here? Two big things I want to key in on. First one I'm going to do is we're going to look at one of the reasons that we may have seen the market absolutely do a 180 and fly to the upside. Interest rates. Okay, the Fed meets next week. Everybody should be able to see on the screen right now what I have up here, which is the CME. Probably shouldn't say that I'm here at the SIBO, but I'm going to say it anyway. The CME FedWatch tool. That is an up to the minute probability of what the Fed is going to do. And that's based on how Fed funds are trading. Okay, there's a meeting next week. Really nobody is expecting the Fed to cut rates next week. I've been saying for a while I really think they should. The market, these are the market probabilities, saying right now 93.3% probability of rates staying the same. This is rates staying the same, 6.7% probability of a cut. Okay, so that hasn't changed. That is not unexpected there. September is the next meeting. Okay, September is the next meeting. There is literally near a 100% probability of the Fed cutting rates. 88% that they're going to cut by a quarter, 12% that they may even cut by 50 basis points. Okay, so that's the September meeting. That also has been priced into the markets for about the last 2-3 weeks or so. Then we go out to November. November is now showing, this right here is just a 35% probability that they're going to leave rates the same in November if they cut in September. But now, 65% probability that they're going to make another cut in November. Okay, 65%. Now, here is the big difference today versus what we've seen in the marketplace. There is now only about a 39% probability that the Fed is not going to cut rates in December. In December, the market is now pricing in right here just over a 60% probability of a third cut. Okay, of a third cut. Boy, how things can change on a dime, right? Some of the eco data we got this morning, GDP, actually was stronger than expected. That would not suggest anything that the Fed should immediately cut rates with GDP number coming in stronger. I think how the market interpreted that, though, was with all of the weak eco data that we have had over the last several weeks, last months or so, the market actually looked at it and said, hey, you know what? Maybe the economy is not doing so poorly after all, right? So they looked at it that way as a positive. Whatever it is, the market really, really traded on that pivot today, in my opinion, based on what the Fed probabilities of rate cuts are this year. We have gone from 6 potential cuts, which was expected at the end of last year coming into this year. Basically, to no cuts projected just about 2 or 3 months ago, back to one cut, and now as many as 3 cuts. What does that tell you about trade? What does that tell you about the state of the market? What does that tell you about, flexibility in the market? It tells you nothing is stagnant. Nothing is, just complacent. We have got to be on our toes, nimble, ready to react because there are so many things right now that can affect this marketplace. The market, I'm not going to say it's fragile, meaning that it's ready to fall apart. Although yesterday, I'm sure all you guys saw it too. I saw it. All the doomsday people, all of the naysayers out there were saying, "All right, here's the bubble. The AI bubble is hit. We're looking at a 10, 15% correction from here." Right? Listen, we sustained a little bit of a correction. That's normal in the marketplace. That is normal in the marketplace. So we've got to be nimble. Volatility is not going away, guys. And that's the next thing I'm going to talk about here in just a moment. Volatility is not going away. We've said this before. We've got the Fed and interest rates obviously front and center. Economic conditions. We've got what else? We're in the middle, in the heart of earnings season. We've got geopolitical unrest still, unfortunately, basically throughout the world. And the political landscape here has, let's just say it's changed quite a bit over the last week or so and added another level, another injection of uncertainty to the markets. All of that adds up, not positively or negatively, it all adds up to volatility. So besides what I said earlier, the adage of bulls and bears prosper, pigs go to the slaughter, what do I say all the time, almost every single day to our students in the rooms? And I say it on TV all the time. And in fact, in little less than 2 hours, I'm going to be standing just over me. If you guys look over there and see those big TVs hanging from the screen there, that's actually the on-floor studio here at the SIBO. I'm going to be right there just after 2 o'clock Central Time being interviewed by Liz Clayman. And I'm going to talk about this exact thing of volatility and buying protection when you can and not when you have to. When you see levels of support, when option premium is cheap, when the VIX is cheap, you buy your protection. And then when it gets really expensive, you've got the ammunition to be able to sell it and sell it comfortably. Okay, what's the other thing we're going to look at here? Volatility, the VIX. Hopefully you can all see what I have on the screen right now. And this comes literally right from the pit that's about 15 yards away from me over here, the VIX pit. Okay, what you see right here is the VIX futures curve. Okay, let me change the color here. I know that red might not be the best there. Yellow is probably better on this background. Let's take a look. And there we go. This is the VIX futures curve. Okay, so if you were to turn on CNBC, Fox Business, Bloomberg right now, even if I look up on the screens right now, and I see VIX, I can see VIX right here. It tells me right here, VIX 1652. Okay, what is that referencing? That is referencing what is called the spot VIX or the cash VIX. Where is VIX today? Okay, the high today, and I see it up here, and fortunately it coincides with what we see there, 1936. Closed yesterday just above 18. So as the market was selling off earlier today, we saw VIX really scream higher. Okay, but what are the rest of these numbers on the screen here? What are the rest of these prices here? What do they show us here? And yes, I know we put out there, if there's any stock that anybody wants to look at today, please let me know, throw it in there. But what are these prices? We have to remember the VIX is a futures product. Okay, how does that differentiate from when we're trading Uber or whatever it is, any stock, well, regardless of the expiration of the options we're trading in any particular stock, they're all tied to the same stock price, right? So regardless of whether I'm trading options that expire tomorrow, next month, 6 months from now, they're all going to be tied to the same stock price. However, in a futures product, so VIX is a futures product, any of your commodities you might look at, like oil, gold, natural gas, copper, whatever it is, even Bitcoin, okay? Futures products, meaning that there are different prices for that asset class based on the expiration. There are different settlement dates for delivery based on the expiration. Now, a normal, typical futures curve, okay, when I say curve, meaning where is the current spot cash price right now versus where it is out in the future. A normal futures curve looks like this, okay? It's upward sloping. It's upward sloping and is referenced by a term called contango, okay? Where futures prices are higher out in the future. This scenario, when futures prices naturally are more expensive going out in the future, happens about 85% of the time. So regardless of the commodity asset class you're looking at, you're going to see an upward sloping curve, and the severity of that curve can change, but you're going to see that about 85% of the time. Okay? Now, what happened yesterday, and I mentioned this to Abigail Doolittle on Bloomberg, and I mentioned it to Liz Klayman, and I know I'm going to mention it again when I get on with her in a little while. What happened yesterday was this current spot cash VIX, which you see trading 1644 right now, actually moved higher than these futures. What does that tell us? What does that tell us? To me, and to everybody else that follows this, that tells us that the fear, the risk to the marketplace, if you will, very short term. The here and now. People are looking for protection right now. They're not worried about a month, 2 months, 6 months down the road, because those futures prices were barely moving higher. Okay, so why the uncertainty right now? Why are people fearful now? Why did tomorrow, which is the end of the week, weekly expiration options get really, really jacked up? Well, volatility increased because of fear. Fear that the market was going to continue to go lower. Continue to go lower. What happens when, typically markets go down, vol goes up, and vice versa. But when you see that inversion like we did yesterday, so rather than the curve being like this, upward sloping in contango, what happened was the curve shifted to that, where it was downward sloping. That is known as a term called, and Mike, did Jeff get that signal out, do you know? Awesome. That is a term called backwardation. That is not a normal tendency. That is not a normal situation that we're in. When backwardation happens, typically that can be a very compelling point in the market and signal an imminent turnaround. Imminent meaning doesn't mean that minute, even that day. But when you see the fear come in, when you see people rushing to buy something right now as opposed out in the future, that is a very, very significant warning signal about a potential turn in the market. This backwardation, okay, when the slope of that futures curve is inverted like this, happens only about 15% of the time. And when it does happen, does not last very long. I can get you all the exact data on that. But boy, when that happened yesterday and then got even steeper this morning, myself, Mike Shore, Charlie Moon, Jeff Lake, we were all talking how, boy, there's going to be some buyers coming into the marketplace. Now, on this same web page that I am on from the SIBO, they also show term structure. Okay, here's our term structure. What does that mean? Term structure meaning comparing the different expirations of the VIX futures. Okay, hey, Peg. Peg. Hey. Come here for a sec. Come here. I got to bring someone in here that I know for 35 years. Peg, you're on live here with everybody.
Hi.
Peg has been on the floor. I think you actually started before I did. She's probably a veteran well before I did. Everybody on the floor knows her. She's one of the good ones down here, guys. Go do what you need to do. Just wanted to say hi. Great seeing you. Absolutely. All right. So look at this term structure that is on the screen here. Look how steep that slope, that curve is right there. And then all of a sudden, man, this thing just started flattening out. This is what we saw over the last day and a half, 2 days. Okay. Now, just because we rallied, actually, from the low to the high today, we rallied over 80 points. Yesterday we were down 120 points in the S&Ps. Today we rallied 80 points. We're about 10 points off the highs right now of where we were. Just because the VIX is not inverted right now. Okay, and how do I know it's not inverted right now? Because this data is telling me it's not. We can see this front month is cheaper than everything going out. Doesn't mean that later in the day, tomorrow, if there's bad news, market sells off again, that it can't flip back. Okay? This is a live up to the minute look, though, of the VIX futures curve. Something you really should be aware of, just for your trading knowledge, maybe as an indicator on is the market turning or not, backwardation and contango. Backwardation and contango. Okay? Super, super important to understand that. Okay, Robert, one of my favorite guys out there, like a treasury inversion. Absolutely. What happens when, people want to, get rid of those T-bills, T-bonds? What do you see here? You see that inversion steepening. And then it comes back in the line. So yes, very, very similar. Okay, it is pretty active here, guys. S&P contract volume now up to almost 2 million. So it is popping here. I did see a big trade in the S&Ps earlier. Very big trade in the S&Ps earlier, where a retail customer, a big customer that was short some slightly out of the money puts expiring today. I believe they were the 5500s, maybe 5480s. Bought those back and sold them for tomorrow's expiration. So big roll, big one-day roll for tomorrow's expiration. Okay, come on, guys. Throw out to me. What do you guys want to take a look at? What do we want to look at on the charts here? There's lots moving. There's lots moving. One, I will tell you, we talked about earnings the other day. So one I will tell you is CMG. Real disappointing. Why real disappointing? We have a bullish position on in this. Earnings came out yesterday after the close. The stock spiked. The stock traded 58 after hours. Unbelievable. And then we come in this morning and it's 51.5, 52 and non-event. So that was pretty disappointing. All right, Airbnb. Earnings on August 6th. Okay, so that is, just about 2 weeks or so. If we look at the chart here in Airbnb, okay, you can see here this blue line, the 200-day moving average. Boy, Airbnb took a big dive below that. That's not a very bullish sign here. That is definitely not a bullish sign. Where would I look for some potential support and resistance? Honestly, next level of support, probably right down here in the 120 to 125 area, maybe 122, 123 to get a little bit tighter. And if this thing moved back up towards right here, which is the 50-day moving average, right around 145 or so, that's going to be some resistance. So the way I would play this, if you're doing something specific for earnings, Bill, I'd probably want to do this as more of a strangle swap, or what we call a double calendar. Okay, where you're looking for a move in either direction. Because to me right now, the stock is in no man's land. Got a week and a half, 2 weeks before earnings. Stock could really move in either direction. All right, what happened, guys? At the top of the hour here when we started, we saw this massive rally. S&Ps were up 40-something. They went up as high as 52, 53 while we were talking, and now they're only up 35. There's lots of angst, lots of volatility in the marketplace right now. All right. Expiration tomorrow, weekly expiration, Friday expiration tomorrow. It's actually a fairly big expiration. There's some decent open interest in the S&P 500 options expiring tomorrow. So we could see some real good activity tomorrow. Plus, tomorrow morning, we get one of the last big eco data numbers that the Fed is going to see before their meeting next week, and this is their preferred inflation indicator, PCE, personal consumption expenditure. Absolutely one of the big potential market movers. So we get that at 7:30 tomorrow morning, 7:30 Central Time, before the market opens tomorrow morning. So be prepared. We could see a big move on that. Right now, though, with the way that we're looking at that CME FedWatch tool, the way that Fed funds have shifted so quickly right now, boy, the market is really looking for some easing coming up here real soon. All right, guys. I'm going to wrap that up for the day here. I hope everybody enjoyed that. Tune in, because again, just after 2 o'clock Central Time at the top of the hour, I am going to be standing right over there where those TV screens are at, and I will be on Fox Business being interviewed by Liz Clayman. All right, guys. Quick one here. Any thoughts on NVIDIA? Ooh, boy, did this one implode, right? But look at it. What a comeback. This thing was down $7-8 today. It was down at 107, 108. And again, if we look here, what did it do? It dipped severely right below that 50-day moving average, which is right at 117.49. So that's going to be another big pivot point here. Okay, if it comes back up, rallies another, few bucks and gets up there, can't hold it, boy, is that going to be a bearish sign. What I would look for if you're bullish is a move back higher through that 117 area, and then if it retreats back but holds, okay, that's my bullish signal there. All right, guys, going to wrap this up. Really, really appreciate it. Again, just after 2 o'clock, I'll be live from the floor here on Fox Business with Liz Clayman. Hope you all have a great rest of the day. We'll see you soon.